Hello Proponomics people, and welcome to this week's 4 Pillars of Property Investment video. So a quick reminder, the 4 Pillars is a strategic framework that I've put together over the past 8 years or so. It's helped me inform myself and keep my strategy current in my property business. It's helped me with seeing roadblocks before they get in the way of growth, and that's one reason and one way in which I've been able to scale a decent sized portfolio. So we are on the second of my 4 pillars, which is the financial pillar. And all of my 4 pillars break down into 7 sub-pillars, just as a little reminder. 3 that are more entry-level / accessible to anybody, and 4 that are more difficult, risky, salty, require more effort, and probably need you to get some education before you attempt to take any of them on. They're not for your first deal if you're watching this and you've still yet to do your first property deal. So this pillar, the second one in the financial pillar, this sub-pillar is about the bank's money. So relatively simple in terms of really what am I referring to there? Primarily I'm referring to mortgages, and I'm going to spend the majority of this, but not all of it, talking about mortgages, because I'm going to talk about other ways in which money can come from the bank that can be useful. So let's kick off with mortgages. What do I always say to people when we're thinking about getting secured debt against an asset? Well, number one, it's secured debt. So there should be really almost a different word for debt when it's secured against a property asset or something that's really not particularly volatile in terms of its pricing. And then when it's unsecured, like a personal loan or similar. It's relatively easy in today's world for people to borrow up to £25,000 from one lender in terms of an unsecured personal loan, and then they can go on and get further credit that's probably well beyond money that lenders should be lending them, in my view. But of course, this sector is regulated, and the regulators, you would hope, know better than I do. But it's always seemed to me that the more you need it, the more you can get. Now, unsecured does not look particularly favourable on your credit rating, because lenders are always concerned about that sort of thing. And they're looking at your utilisation as a percentage of the amount of credit you've got available. So if you have no credit cards, you might be aware that's not particularly good for your credit rating. The best way is to have one credit card and pay it off in full every month at the end of the month. When you're more sophisticated, you can look into 0% balance transfer deals for cards and things like that. And that can be really useful, especially in times of inflation like we've been having, because the amount of free credit effectively, or free inflation eaten credit that I've been having, has been frankly quite ridiculous over the past few years. But that's the unsecured side of things. The other things the lenders will look at is your utilisation. So the worst thing to do is have one card, and let's say the limit was 10k on that one card, and be using over £9,500 of that limit. Over 95% of a limit is a particular flag that lenders really don't like, right? So bear that in mind. The best way is to stay under 25% of utilisation. So stupidly, you could still borrow that £9,500 if instead, say you had 4 cards with a 10k credit limit each, and you borrowed £9,500 spread relatively evenly across the 4 of them, you would be under the 25%, and your credit rating would look completely different, even though you'd have the same amount of unsecured debt. But let's go on to talk about secured debt and how we can use that in property. So secured debt means it's secured against an asset, usually called a mortgage. The simple line between a bridging loan and a mortgage, as a rule, in terms of the regulations, is one is for 12 months or shorter, that's a bridging loan, and one is for longer than 12 months. Now, bridging lenders will do 2-year bridges sometimes, or perhaps even more, project length bridges, and often development financing is for more than 12 months, because there's financing to buy a site, the pre-commencement conditions, there's all sorts of stuff going on, and quite often the dev loan is for more than 12 months, not always, but there is a bit of a blur there. Now, mortgage side, you're securing the debt against that asset. The lender gets what's called the first charge, which means anything goes wrong, they have the first call, the first right on that money. And anyone else who ranks behind them in second charges or similar, the first charge holder has got to be paid back with all their costs, first of all, before there's any more money to distribute. That's why it's such a strong position to be in. But having said that, if you lend on a first charge at 100% of the loan to value, it's not so strong, because if anything goes wrong, you're very unlikely to get all of that money back, because remember, there's also a cost of recovery. But the bank has money that it wants to lend. Sometimes it's not the bank's own money. Sometimes it could draw it from the Bank of England. Sometimes it could draw it from other banks. And they would use what's called the swaps market in order to provide money for mortgages that they want to lend to people. It's secured, it's boring, But who likes boring? Well, people like pension funds, they love boring. And what's the good thing about mortgage debt as well? It's long term. Average terms now over 30 years. So a pension fund that knows it's got all these people in it, it's got all these people it's already paying out who are above the pension age, who are taking their pensions, and it's got these other people in it who are still contributing to the fund, who are perhaps as young as 18 years old, between 18 and the top working age, say 65, 67, there might be contributors as well. And what the pension fund knows is most of those people will still be alive when they come to draw their pension. So they need money in order to pay them, and they need that money to pay on a regular basis, i.e. monthly. So buying things like mortgage bonds, mortgage-backed securities, you'll have heard of collateralised debt obligations and things like that. If you've ever watched The Big Short, one of my favourite movies, one of the things that caused the system to nearly collapse in 2008. But bundling lots of mortgages together and then selling them, securitising that income stream, selling it to a pension fund or similar, is what the banks are really trying to do. They're going out there doing all these individual loans to the likes of you and me, aggregating them together, putting them together, and then selling them to someone who wants that monthly income stream, even if the return isn't particularly exciting, even if that return is 3, 4, 5%, as it would be as a broad brush over the past number of years, perhaps some 6% last year. And of course, there might be a fixed period and a variable period, and that can be addressed using the swaps market as well. But we'll leave those complexities for another day. How do you get mortgages? How do you remain financially attractive? I talk a lot about being financially attractive. I mean, obviously, I try to be as attractive as possible. But from a financial perspective, what do people want? What do lenders want to see? For a long time, they wanted to see an income of over £25,000 a year. And some lenders still do want to see that, right? At some point, they didn't want it to be from property, although that requirement has been relaxed over the years since we've got away from the financial crisis. They want to see that you've got a positive balance at the end of the month. Your income versus your expenditure leaves a positive sum, right? That's what they'd like to see. They're also going to look at the quality of the asset. Of course, they are. What's it worth? They're going to get an independent third-party valuation, and they're going to be able to sue that person if that valuation is completely wrong. And that's going to be an RICS surveyor, and that surveyor has to carry professional indemnity insurance for that purpose. These things only tend to happen in a big down market when everybody starts turning around and pointing fingers and blaming each other. But RICS surveyors, by their nature, are generally fairly cautious people. And the average age of a RICS surveyor, the last time I looked, was about 62, I think. So there is a known problem in the RICS of getting younger people into the surveying industry, apart from anything else. But what does it mean when the average age is 62? It means look at all that experience that those people have got. Average of 30 plus years of experience after they've done their degree and they've got their practicing certificate. Then they've got all that experience. So 30 years experience, you would have seen the 1990s. You would have seen 2008. So it lets you be realistic in terms of what price you're going to give to a property instead of overvaluing everything. It can ebb and flow, especially when you talk about commercial valuations, and they tend to be an awful lot more risky than a residential valuation. But really what you're looking to do is get particularly cheap money from the bank that is well below the rental yield of the property. And when we're talking about the rental yield in that context, I'm talking about the rent minus the operating costs of that property, right? So how much do you pay an agent if you need to? How often is it void? What do maintenance issues cost on average? What does compliance cost you on average? What does insurance cost? All that needs to be factored in. So there's no point saying, right, I've got a property that yields 6% and the mortgage rate is 6%, so I'm okay because they're the same. Because they're not, because there are running costs involved. And if you were to mortgage that property, you'd be doing what's called negatively gearing, which can be quite dangerous. So this is where we look at the concept of the interest coverage ratio or the debt service cover ratio. Now, the legal guidance on this from the regulators is 125% of the rent. So if the rent is 1,000, the debt service cover they would only want to lend £800 in terms of payments every month against that, because 800 times 125% is 1,000. Now I can tell you in reality, if you're a hands-off armchair or overseas landlord or similar, you won't be able to run that property for £200 a month. Your costs are going to be more like £250 to £300, depending on what it is and where it is. Of course, if it's a new build property or something like that, there might well be a lot less. There might still be a builder defect warranty. You might have done a big refurbishment, But of course, you've got to remember with these assets, you're looking at a lifespan of potentially 20, 30 years or beyond. If you're buying in a limited company, perhaps you're going to pass the company down to your children. Perhaps you're going to sell the company, and at that point, you're going to need to justify how have you looked after these assets, because they are supposed to be long-term assets. And you can't put sticking plaster on something that requires surgery. And if you don't get your repairs and maintenance right, your little problems will turn into big problems over time. And that will be the unwinding of your portfolio. And what will happen, as has happened to so many people that I've bought portfolios and properties from, is that at the end, they've squeezed the lemon so hard for every single drop of juice of cash flow, they end up having to sell it at a pretty significant discount or well below its true potential, because they've spent the money instead of being able to reinvest the money back in. And they're not really property investors, those people. They're people who've used property for income. And that's such a big difference. I cannot emphasize that to you enough. So remain financially attractive. What are you going to be able to get? Up to 80% loan to value for residential, maybe even 85 in special circumstances. There's been a bit of 85 over the years. When there's risk, those loan to values tend to drop back, right? So people get a bit concerned about those, and they don't want to see too much over leveraging going on, because they've got to think about their margin of safety if they have to repossess the asset, if they have to take it off you. And there's costs of doing that, of course. And then when an asset has been repossessed, when it's in receivership, you don't tend to get, it's a fast process. It's a horrible process. The receivers and the asset managers try and bully you, and you don't get all the information you would like. So you have to pay a lower price in order to protect yourself from that. It doesn't always work like that, because relatively inexperienced people think that, oh, it's a repossession, so it must be a bargain. It's not necessarily the case. It still needs very careful assessment. And sometimes it's quite hard to buy repossessions with mortgages because there's not that level of time frame. If they're letting you use a mortgage, it's likely that the price isn't that good in the first place. So you just need to be a little bit cautious about that. But that's your loan to value. Your rates at the moment, as I'm recording this, you're talking about a shade under 6% with no fee. And you can get quite a lot lower. You can get 4 point something percent products, but you'll be paying a whacking great fee, maybe up to 7% on those. And you've got to factor in that 7% from your total returns on that property over time. If you're paying 7% fee, oh, well, if it's added to the loan, it doesn't matter. Well, it definitely does, because at some point in the future, when you sell it, or even at the next remortgage, in 5 years' time, at your next remortgage, you've added 7% to the cost of that loan. So 7% of a decent slug of that capital growth, 7% on top of 75%, right? So around about 5.25%. Or the first 5.25% of all the capital growth in that property will go in paying that 7% fee. And then you're going to have another product with another fee, probably in 5 years' time at a lower rate. That would be the expectations that I have, certainly, at the moment, and that would be the expectations of the market. But of course, there are no guarantees of anything. So I'm more comfortable with these big fees on 5-year products than I am on 2-year products, where they make me really, really uncomfortable indeed. But ultimately, you've got to do the right thing for you. If you decide you might be selling an asset in 3 years' time or 2.5 years' time, and you don't want to pay the early redemption charges, I would still encourage you to look really closely at the products, because then you've got to make a value judgment. Are you definitely selling it at that point? Well, what if the market's collapsed again at that point? Again, that looks extremely unlikely with where the market is today and the relatively slow upward trajectory we're on at the moment, that we'd have a big crash in 2 years' time. But who knows? Because there are external factors, and if I was recording this video in 2018, I doubt I would have been talking about a global pandemic in 2020, for example. So anything can happen, can't it? Let's face it. So remain financially attractive. My personal view is that exposing yourself to more than 20% of your debt with one lender is not a wise thing to do, maybe up to 25. Some of the only problems I've seen some really sensible, accomplished, hard-working people have over the years is that they've relied on one lender. I bought a portfolio once from a big group that only had one lender, and the lender was putting pressure on them to dispose of that portfolio, and they sold it to us at a 33% discount to the valuation that we got, just because they only had that one lender, and they were relying on that lender to give them more money for a bigger project somewhere else, where they were going to make more money than they lost in terms of disposing it to us, right? And also they were quite realistic about when you get rid of a big portfolio, it's likely that there will be a discount, unless it's being sold to a pension fund or similar, in which case you might even get a bit of a premium. But you probably need something special going on, some kind of support being provided, some kind of lease with a registered provider, some kind of income guarantee, because that's what these places are looking for. They're not looking for a portfolio of residential property where you've got to work quite hard in the private sector. Although, of course, in build-to-rent environments, they do accept that there will be private sector tenants. They're looking for an incredible amount of demand, and they know that supply is very weak as well. So remain financially attractive. Think about your loan to values. The risk is not linear, right? When you start going over 60%, the risk starts to tick up a bit, till you get to 75, and then in my opinion, it starts to go up like this, right? So you need to be careful, and you need to be careful on the pricing, because sometimes if they add 0.4% on for an 80% loan to value, the actual cost of that extra 0.4% might be really quite high. You'd have to multiply 0.4 by 15. So what would that get you to? 6%. It would be costing you 6% on that money, because that's the marginal cost. So if you went from 5% to 5.4, the extra bit is not costing you 0.4, it's costing you a whole 1% across the whole of the loan. So just think about that, and that's how you work out the mathematics of that side of things. It's worth knowing. Obviously, you need to make sure you never miss a payment. That's the best way to remain financially attractive. Get on top of your credit rating if you're not already there. But this enables anyone who's got a deposit and enough money for the frictional costs like the stamp duty and everything to be able to buy a rental property and get their first one. The problem then becomes, where do you get the next deposit from, of course? And you have to go back to some of the deals videos in the first pillar of my 4 pillars to have a look at ways and means of getting deals, in which case you can try and get nearly all or even all of your money, or even money on top, pulled out. They are rare. They're not complete unicorns. It's very doable. I've done it over 100 times. In fact, I've done it over 200 times, got all my money back out and more. So it definitely can be done, but it's not easy. So look into the mortgage side of things, remain financially attractive, use the bank's money because it's cheap. Thank you.